Hi, this is Jared Clements at Watson Realty. We are continuing our journey into the we're continuing our journey into the MLS analysis. This video is going to be much shorter than our last video. This video assumes that you're going to download the spreadsheet that we developed in that 1.5 hour training on MLS analysis. And the purpose of this video is just to see how to use that spreadsheet if you're not going to develop one from scratch. If you're just going to use the one that you downloaded from jared@watson.com, how to analyze all those properties on the multiple listing service to know which one to put an offer in. Because unlike buying a house, when you buy a residential investment property, you put the offer in before you get to see the property. So you can do this from your home, from your couch if you like, but let's see what we're going to do. So I've downloaded the spreadsheet from the website. We're going to spend a minute or two to go over that, and then we're going to take a look at how to add data to it. Okay, so we have 3 tabs on the right spreadsheet over here. Okay, universal data, property data, and results. Okay, it has example data on it already. If you're downloading this from the website, just delete all the stuff here on lines 2 down and start fresh on line 2. I want to use example data, so we're going to leave those there, and I'm going to start down here on line 9 instead. On the universal data page, you will set your amount of cash available here. If you have changes in the mortgage rate, you'll change those here. But for now, just leave those the same. This is late 2019. These are accurate estimations on the conservative side for the current investment market. Okay, mortgage rates for investment properties are higher than mortgage rates for owner-occupied properties. So right now we're getting 3.6% for owner-occupied, 5 to 5.5% for a 30-year mortgage, conventional. The annual maintenance budget, we're going to set at 2.5% because on the national average, I keep transitioning away here. On the national average here, 2.5% reflects what is available across the board. Okay, not what is available. It reflects the amount of money that is necessary in order to maintain a property in its current condition. Okay, so if you're spending less than 2.5% on your annual budget, chances are your structure is getting a little bit worse every single year than what it is now. If you're spending more than 2.5% of the property value every year, your property is going to get a little bit better every year. 2.5% maintains the status quo. So we're going to be buying properties that we think are not up to our personal standards. So for the first 5 years, we might set this at 5%. But after the first couple of years, once we get things steady, and once we have the property to where we like it, we're only going to make big investments every 5 to 10 years when there's a massive shift in the economy, or we have a really good year and we have some extra cash to throw around. Other than that, we're going to try to maintain our repairs at a 2.5% budget. Reserve for immediate repairs. Out of the $85,000 cash that I have to keep aside some money for 2 things. First, there's going to be those things that I need to fix immediately. These are going to be, in the last property that I walked through, there was a fence that I was going to need to remove immediately because it fell on the occupant and caused 14 stitches. That is not something I, as the new owner, want to be liable for. So I'm going to pay some money to remove that gate, all right, that fell over and caused that damage. I might spend some money to replace it. I might spend some money to fix some of the electrical issues that I identified on that particular property, which was on Quincy Street. There was some mold issues. I knew I was going to need about $2,000 for mold remediation. So you want to reserve some cash. At this stage of the game, estimate about 5% of your purchase price, just to give you some wiggle room, some room to play. Estimate another 5% for closing costs. Okay, closing costs are things like your title and escrow fees, your insurance, your title insurance, prepaid taxes, prepaid property insurance. Those are what you're reserving here. Now I've created these as percentages so that you can customize this sheet to what is right for you. And the number that you're going to change most often is the cash available for close. On the property data, we've already kind of said we're going to start on line 9. Let's start adding some information here for 618 Lincoln Street. Now this here is direct access to the Kern County MLS. This is the portal view that we give to clients, and it gives you a whole bunch of detailed information here with a nice bootstrapped image here, with the buttons, big buttons, etc. We're going to do 618 Lincoln Ave. Price is $199,900. And this one here, down here, we're going to look here. It's got total number of units is 2. It's using actual income and expense. So as I come down here, I've got $800 for unit 1, which is 3 bedrooms and 1 bath, and $500 a month for unit 2, which is 1 and 1. Those are good numbers. And because they're actual, we will mark true and true. Notice here that there's some false numbers, and there's sometimes true and false. These are cases where they said we're using actual data, so this is the number they said they're actually receiving for unit number 2, but they didn't have a value for unit 1, so I had to estimate it. So that I put false. When we put false in this column, the effect is it reduces the rent that we use for our calculation by 10%. This protects us in the long run. We want to be extra conservative with fake information. When we're using predicted data, when we have a vacant property and somebody doesn't actually have a tenant, when we have maybe we have an actual tenant but they're not telling us what the tenant's actually paying, by using pro forma data, we want to reduce our estimate by 10%, and that way when we actually go out to rent the property, we've got that margin of error to play with, and the numbers are much nicer than what we see on the form. That way, if we see something that looks good on this analysis sheet, it'll look even better in real life. And that puts us in a good position and reduces our risk. That's the key in investments, reducing your risk. Let's go back to the sheets here. All right, so let's take a look at the area score. So I've brought up 618 Lincoln Avenue on Google Maps. I'm going to grab my little man and drop him. So the way that I score areas, I start with a score of 10, and I look around. Now this is a very recent picture. Down here it says May 2019. I've got some damaged vehicles. I've got crowded streets. I'm going to subtract 1 for the crowding. I'm going to subtract 1 for the damaged vehicle. If we come up here, if I see, that's not too bad. If I see boarded up windows, vacant lots I don't care about. Vacant properties I do. That's actually not a vacant lot. There's a house right back there. Here's boards on the windows. Do you see that? Boom. Subtracting 1 right there. So that brings us down from 10 to 7. Okay. If I see homeless people on the street, if I see lots of cars, as I go back up, and with the Google camera, you want to go up, back and forth because each picture is taken at a different point in time. Here's more boarded up windows. I don't subtract twice. Once I've subtracted for boarded windows, I don't subtract again. So we've subtracted for that. But each of these is at a different point in time. So as you go back and forth, you might see cars driving past you. If it's on a busy street, I'm going to subtract 1. Got the neighbors there. So if I see a bunch of like garbage in the front of the house, I'm going to subtract 1 for garbage. So the area here is a 7. Okay. So the area score doesn't affect any of the financial numbers. But if I have 2 properties that are really close in their value to me as an investor, I'll choose the one with the nicer area score. It's very arbitrary. And if the score goes too low, I'll just stay out of the area entirely. Okay, so once we have this little bit of data here filled, we can go to the results tab. And let's just kind of focus on this for a minute. Okay. So you notice that the property that we just did, it's not showing up here. All right. So what we're going to do is we're going to highlight the last line and just drag it down. And then anything that has a 0 here, we're just going to come back and we're going to delete this. Okay. So this here is the property that we just added. It has an 8% cap rate. It has a 33% down payment. Okay. So this is not something that's inherent in the property. This will change depending upon how much cash we bring to the table. Okay, we want this number to be close to 25% to get the best return on our investment. Okay, here we have cash is negative. Oh, you know what? We also didn't include. Did we include taxes? We have estimated taxes here at 1%. Was it actually listed here? Total annual income, vacancy. Okay. When there are no taxes listed, estimated at 1% of the purchase price. Okay. So let's go back here. So we would have to pay money every year in order to own this property with this kind of down payment. The only way to make this work for us is to increase our down payment or buy it cash, right? So let's go up here. Let's see here. Let's do 150,000. Okay. All right. Now we're paying for 65% of the property with cash, and the rest of it will be financed. Now we get finally some positive cash flow, but now our return on investment is so low. All right. The more money you bring to the table on an investment property, the lower your return on investment will be. So we're putting in $150,000 in this property, but we're only getting $3,000 back per year. Okay. Not to mention the fact that you've also got equity. Now, the return on investment calculation includes both cash and equity, which is why you'll see sometimes a positive return on investment for a negative cash flow. Okay. So generally speaking, with an investment property, you want to come in with as little cash as possible. Use the bank's money. Okay, so let's bring this down to 85,000 again. All right. Just looking at this, I'm going to reject this property, and I'm going to do that by coming over here, and I'm going to click reject. Boom. Okay, that property is now rejected. All right, we'll go back to the listings page. We'll grab the next one. Okay, right here, 712 Wisteria. Okay, price $149,900. Okay, if it doesn't have the right formatting, you can add it. That's okay. Area score. Let's check this one out. Okay, so we're going up here to Google again. 712 Wisteria. Okay, can't find it. Wisteria. Oh, that's because it's an E. There we go. Wisteria Street is in 08. It is. Let's correct it on our sheet. We can't correct it on the MLS, but we can correct it there. Okay, so let's zoom out a little bit. This is on the... Okay, I've got an idea of what this neighborhood is going to look like, but let's zoom in here and use our scoring system, right? We're going to start at 10, and we're going to subtract points. All right? Remember I said I'm going to subtract points for junk in the front yard? Now, this junk is the effort of cleaning up, but I may still count that because I have no idea how long that's been there. Could be recent. And I have a feeling on this street we're going to see other stuff as well. Look at that garage door. I'm subtracting a point for that. Okay? So we go from 10 to 9 because of the tree rubbish. We go from 9 to 8 because of that door. I don't see a lot of cars on the street. I would subtract if I did. Boards on the windows. Do we see any boards on the windows? I would be surprised here if I didn't. Now this picture is from January 2012. And again, this street looks nothing like this today, but this is our best way to look at the property without physically going to every single one. And we're going to do a physical inspection of the property once we put it under contract. All right. So I'm going to subtract another one just for clutter in the yards, because we got clutter in the yard there, clutter in the yard here, clutter here. Seems to be a street-wide kind of issue. So we're going to put a 7 on the area score here. Oh, and I'm putting this on the wrong page. Let's delete that. Always put it on the property data page, right? 712 Wisteria Street. 149 900. Okay. The area score we said was 8, I think. No, it was 7. Okay. Number of units. We'll go to details. Number of units is 2. We're using actual numbers here. That's good. Okay, we got 1 bedroom, 1 bath for $525, 1 bedroom, 1 bath for $500. Those are decent rents for that. True, true. Okay, let's double check, see if there's any taxes listed. Total annual expense. Now you'll notice I'm not including the annual expenses because generally speaking, I assume other investors are not treating their property well. Okay, so I would put my budget at 2.5%. This is less than that. This is about 1% of the actual property value. Annual net income is 10.8. Annual net income actually is 12.3. Oh, that's net income, not gross. Yeah, 12.3. There we go. Vacancy factor of 1%. Okay. So we're just going to base this off of the actual rent income, off the property price, and off the taxes. And the rest is going to be estimated using our form values. Okay, remember when we add a property, we're going to come over here and we're going to bring this down. I'm just going to bring it down to 1. Okay, so with a down payment of $85,000, we have a 8% cap. We're paying for 47% of the property. It cash flows $1,000 per year, but only a 4% return. Okay, remember what our rule is about return? We're going to reject this one. That's a bad property. Okay, we can play with that, but the numbers aren't going to look much better if we come down on price. 65,000. We can increase the return. See, it went from 4 to 5%, but now we're paying $300 a year to maintain this property. Okay, now over the course of 30 years, $300 a year times 30 years, you're paying $9,000 to get a property owned free and clear for $150,000. So is there a good return on your investment? Yeah, that's not bad, but it takes you 30 years to realize that, and it's going to cost you money every month. As an investor, you really want to have positive cash flow on a month-to-month basis, especially on an annual basis. So you stay away from the properties that are going to bleed you dry. Okay, unless you have a lot of extra income and you really don't care and you're just looking for places to hide it. Okay, so let's take a look here. Okay, we're gonna hide some of this data. Okay, this is a bad property. Let's get rid of it. Hide. This is a bad property. We're gonna hide these. Okay, this one's positive on the 30-year, negative on the 15. We'll leave it there for now. This one's negative cash flow. We're gonna get rid of that. Okay. Here we've got 5 and 6% returns. I don't like those returns. I really don't. We don't need this property. We can hide that. Okay. My cap rate, I generally like properties that have cap rates between 9 and 11%. Once you start going above 11, you start seeing things that require additional investment for immediate repair. But you won't know that until you actually visit the property. This property here, if you watch the 1.5 hour long video where we go over the analysis, I suspect that this is actually going to be a real winner. The cap rate's really high, but that's because they haven't been renting out the one unit. They've been living in it. And so they use actual data based on one unit, and the real estate agent, I think, undervalued the property. But we might put an offer on it, get there, and find out that the second unit is unlivable. So that could go either way. It could go either way. But here's what I'm looking at, right? So I want this down payment percentage to be around 25%. These are really good, okay? So right now this is with a 65 investment. For these, I'd probably want to increase my cash a little bit if I was going to invest. So let's just see what happens if I put in, let's go to 75,000. Okay. So now I got 25%, 23%. Look at these returns, okay? All of them become cash flow positive on the 30-year mortgage, okay? 3 of them are cash flow positive on a 15-year mortgage. I got 28% return, 27% return, 15%, 16%. These aren't bad. You know, these are good numbers. And ultimately, I would get any one of these top 3 properties with these kinds of returns. That is steady, predictable, regular income. I would put offers on these 3. And I would, so the offer is being made subject to interior inspection. I would have the properties all inspected. I would put offers in on all 3. And I would say in the contract that inspections will occur on a specific date, and the earnest money deposit will be in by a day, 3 days later. I would put that in the actual offer. That way you can come to town, visit it on just one day, go visit all the properties, and then whichever property you don't like, you pull out the offer. You say, look, I'm sorry, I didn't really love the interior inspection, and I want to withdraw my offer. You don't have to part with your money because you put in your offer that you wouldn't put the earnest money deposit in until after the inspection was done. That gives you the ability to see all 3 of these properties and choose the best one. Now, let's say that you're in a situation where you have several $100,000 to invest. In that case, if you can break that down into 3 $75,000 chunks, you could actually offer on these 3 properties and close on all 3 properties, and you're going to get an amazing return with a very happy investment portfolio. Now, naturally, there's a lot that goes into classifying and analyzing the different aspects of a property. This video is all about just how to narrow down all of the choices into ones that are actually going to be profitable for you based on your financial data and the way that you like to run your property. When you're getting started, use the data that I have set as a guideline. Okay, don't change the 2.5%, the 5%, 5%. Don't change these. Do change the amount of cash that you have available. And then on the results, if we expand all the hidden data here, you'll see how that money is being divided and spent. Okay, so of the, let's see here, it was 75,000. Of the 75,000 on this property, we're reserving 9,450 for immediate repairs. Anything that we see on the property that we're like, you know what, I wouldn't be okay renting the property out like that. Or if you've got a health hazard like mold and you need to take care of it, that money is for that. Closing costs, these are going to be the things that you need to pay for as part of the transaction. The cash available for the down payment is $56,100. You don't have to use all of it. You can finance more of it, but that's what's left to pay for the house with. And you can, of course, then play with the numbers to see how your returns on investments are. All of your category totals are here, your maintenance budget on a monthly basis, your estimated insurance. Oh, I got to fix that. Okay. Okay. But, yeah. So anyway, there's a lot here to play with and learn. That's how I would pick. I just realized I didn't show you guys my screen for that. So, but anyway, that's how I would pick. Let's transition so you could see it. So I expanded This is on the results page. Usually this here is all hidden. Okay, so this is the page that we were looking at before. If you want to see how your money is being divided on the spreadsheet, unhide here. This is the amount that's being reserved for immediate repair, $9,450. This is being reserved for closing costs. This is what's available for your down payment on the actual property, and then you can spend less than that if you want. Play with the numbers. Look for a high returns on investment, and those returns on investment are not the kinds of returns on investment you'll get anywhere else. This is why I love real estate, and I'm here to help you. Call me if you have questions. You can always click in the area. If you're watching this on the blog page, click in the title bar above, and that'll dial my cell phone. Okay? So good luck to you, and I will see you next time. If you have questions or suggestions for videos, email me at jaredclements@gmail.com or jclements@watsonrealty.com. And of course, come visit me at jared@watson.com, which is my website. Have a great day.